All right. Welcome to the What Are Your Thoughts Halloween Spooktacular. Starring Michael Batnick and me, Fetty Krueger. I almost went with Count Spacula. Would that have been funnier?
Oh, man.
Count Spacula might have been better. We'll save that for next year, though, right?
I spent 10 minutes trying to come up with something, and I was just drawing blanks. Blanks.
You should have called me. I had extra names. All right, guys. So nice to be here with you all. Big shout out to the commenters. Thanks for everyone who joins us every Tuesday evening at 5 p.m. for the live. We really appreciate it. We have so much to do today, still in the midst of earnings season. We do have a sponsor I want to shout out as well. But before we do anything else, I just want to remind you, parents, check your children's candy before, right? What's the thing that you're supposed to tell people on Halloween? Check the candy. And what's
that was
the
like
other
a thing
thing?
that was like a thing in the 80s, right?
Why nobody's messing with the candy anymore? I don't know.
Well, it's all wrapped. Nobody gives out apples anymore.
Yo, I have a confession to make. I never check my kids' candy, not even one time. You check your candy. Welcome to the real world. Check your own candy. All right, Michael, would you like to tell us who the sponsor of the show is today?
It's public.com.
Okay, say more.
The yields are getting extra spooky. That made no sense. So the title of today's show is what? What are we calling this thing? Stop crying and buy bonds?
Yeah.
All right. Well,
stop crying, buy bonds.
What about bills?
I'm standing on that.
Treasury
bills too. You don't. The good news is you don't have to choose.
You can do both. I do both.
Yep, me too.
Do I own bonds? No, but I own bills. I'm a bill guy. You can get, what is the 6-month yielding these days? 5?
Yeah, 5.5%. Now, here's the good news. If you log into the public app and you're buying on a regular basis, you're just shooting cash over there from your bank, you're earning 5.5%, give or take, on 6-month T-bills, and public will roll them for you automatically. So you don't know when they mature. You don't have to think about it.
You know how much my checking account is paying on my cash? Nothing.
Yeah, me too. I'm with.
I got it out of there.
I'm like with one of the big four banks.
I got it out of there.
I sent money to my public app. I think yesterday. So 5.5%, and it's not forever. And at some point, T-bills will go down in yield, but this is where it is right now. So get it while the getting is good, I guess. Where
one
do we
last
send
thing.
people to?
What public.com/compound. But one last thing, just so everybody is hearing us loudly and clearly. These are annualized yields. So you're not getting 5.5% over a 6-month period. It's annualized. All right. Let's talk about a fourth quarter rally? Question mark.
Yeah. I don't know. We're running out of time. Tomorrow's November.
Okay.
So if we're gonna do this, let's do this.
So here's Mike Wilson. He's not in the fourth quarter rally camp. He said over the past month, we have been arguing that the chances of a Q4 rally have fallen considerably. Our observations on narrowing breadth, cautious factor leadership, falling earnings revisions, and fading consumer and business confidence tell a different story than the consensus, which sees a rally into year end that's based mostly on bearish sentiment and seasonal tendencies. Let's pause here. Is consensus for a year end rally? How do you measure that? Yeah?
Yeah. We had one last year. It was the worst year ever, and we still ripped into the end of the year.
Okay. So he said
we were down like, how much was the S&P down at its low October of 2022? Was it down 25%?
20 something? Yeah, it ended at what, down 17?
Down 18. And by the way, everyone went into the end of the year bearish. You remember we were live at the NASDAQ with a whole audience full of it.
Super bearish.
But the market had already started ripping into year end. So yeah, I feel like there's a lot of muscle memory in this period of time during the year. It's where the source of a lot of the gains historically happen in this window. And I do think, like, even if people don't say they think there's going to be a year-end rally, they kind of know there is.
Well, I'll put my hand up. I expect a year-end rally. Sorry. That's just how I think. He said Q3 earnings season is eliciting even weaker performance post-announcements than the sell the news reaction during the second quarter earnings season. The median next day price reaction so far is negative 0.7%.
Yeah.
It was 0.5% last quarter. So I thought that was pretty notable.
So hold on. So this is the next day, the median stock after earnings, good or bad, has been down almost 1%.
0.7. That's right.
I mean, that's horrible. That's not horrible earnings season.
That's not great.
Median.
The percentage of positive reactions is also lower at 45% versus 47% last quarter. And then he says, most importantly for the index, most of the mega cap leaders that have reported so far have not traded well post result. Well, this is sort of mixed. Chart on, please. All right, so this is Amazon, Microsoft, Meta, and Google. Amazon up 10%, Google down 10%, cancel each other out. Microsoft up a little, Meta flat. And then we've got Apple. Apple.
But wait, Mike. But the important point is, all four of them beat.
Sure.
It's not Google down 11%. It's not like they missed numbers.
True.
So that's not a lot of fun to get to get the earnings call right and then lose 10% of your capital the next day is not fun.
Let's talk about breadth. So it is what it is. Breadth is not great. The percentage of stocks above their 200-day moving average is under 30%. Matter of fact, I saw a stat, something like there's a weird divergence where less than 30% of stocks are above their 200-day and the market is only in a 10% drawdown. I feel like that's very shallow. Usually when it's that bad, the index is doing much worse, right? You're not in a 10% drawdown, you're like a 15% drawdown.
This is back to the AI. It's AI versus the S&P 490. And nobody can convince me otherwise at this point. Like, this is what's going on.
And then if you look at the percentage of stocks above their 50-day moving average, this is pretty much washout levels.
That's in the sewer. That's negative. That's what is the reading on this? Percentage of S&P stocks above their 50-day.
It got down to 10%. Now
10%.
Yeah, and over the last decade, it's done this, I don't know, half a dozen times. It's pretty much a washout. A washout. However,
that's where the rally should start from. Like, if it's going to happen, that degree of washed out internals.
You could easily make the case that, breadth is horrible. None of that's actually bullish. Like, that would be sort of a ridiculous spin, but maybe it's not a ridiculous spin because we already had the bear market. Well, I don't want to say that. We already had a washout.
Hold on. But you have to decide, are you a catch-up guy or a catch-down guy? We had Dubravko Lakos on the halftime report today. And Scott was asking him, just like walk us through why you're bearish. And he's been bearish all year. He's been saying
I'm a Heinz catch-up guy.
He's been saying like cash is king all year, to his credit. He missed the stock market rally, but he also missed some losses in bonds, whatever. But he's basically saying, like, look how bad the typical stock is. Most of the market is already selling off, and it's only a matter of time before the index rolls over. That's a catch down guy. Somebody else could look at this same setup and say, here comes the catch-up trade. The mega caps held us down all year, held us in all year, and now the S&P 490 are going to have their chance to rebound. And by the way, historically, that would coincide with the end of this. We talked about it last week. The mutual funds ending their fiscal year on October 31st, and a lot of this tax loss selling being in the rearview mirror.
I'm sorry. Look how bad the average stock is doing. The median stock, well, the equal weighted S&P is down 2.6% year to date. That's not so bad. Yeah,
no, compared to the index return. That's all he's saying.
I know. It's
relative.
Okay. Let's look at a chart from Sutmeyer. Zooming out a little bit because we were all the way zoomed in. All right. We're looking at a weekly chart going back to 2011, and Sutmeyer says, based on the rising 40 and 200-week moving averages, the S&P remains within cyclical and secular uptrends. The July to October drop below the 40-week represents a correction within these bullish trends. If stronger seasonality can take hold in November, reclaiming the 40-week moving average would confirm the view of a correction within an ongoing cyclical and secular uptrend. And I know it's easy to get bearish.
He found two moving averages that make it look good. That's pretty impressive. The 40-week and the 200-week, great. I don't like.
Is this an uptrend? Is this an uptrend?
Yeah, no, it is. I'm just breaking balls, but I don't like the way it looks on the 31-week and the 176.
Dude, whatever. It's an uptrend. Whatever. It's a long-term uptrend.
Fine. No, listen. I want him to be right. If he's right, we all get
any long-term moving average.
We all get our stocking stuff this year. You know what I'm saying?
Any long-term moving average. Here's a chart that I wanted to share from Jason Gephardt at Sentiment Trader. The economic surprise index. It's weird. It's this weird, strange thing. We spoke about this with Tom Lee, that the leading economic indicators have been negative for a long time. And yet the economic surprise index from Citi has been higher. So I'm not sure how to square that circle, but it's above 50. And when it's done that for any period of time, I forget what the exact number is. The S&P. Hold on, let me explain. The S&P 500 is up 75% of the time over a 3-month period, and 85% over a 6-month period. That's pretty meaningful. Now the average gains aren't that much higher than normal. I don't think, but the percentage of time that they're higher is pretty notable.
The win rate. I want to ask you, when you say I don't know how to square that circle, economic surprise index doesn't really have a lot to do with leading economic indicators. I mean, I know you know this, but for the audience's benefit, leading economic indicators are like measuring the things that are the most urgent or the most recent, as opposed to the lagging economic indicators. Surprise index is what the actual news is relative to what the consensus had been expecting. So to square that circle, everyone is still pessimistic, but things are just not as bad as they thought they would be, hence a rising economic surprise index. Am I explaining that well?
Yes.
Yeah?
Yeah.
Okay.
So when I said I was expecting a fourth quarter rally, honestly, the truth is there's not a lot of, in my opinion, I think the weight of the evidence, I think you have to give it to the Bears into the year end. Like, I don't know what a bull can hang their hat on for the last 60 days of the year, other than people are bearish. There's a washout.
How about, I don't know, I'm just spitballing here. Spirit of Christmas? Santa? I mean, what the hell's wrong with you? Well, nobody has to hang their hat on anything. The news doesn't have to be good. It wasn't good last year. Once again, there's a mechanical selling that takes place because of tax losses, and it exacerbates prior trends. It hits the stocks that had already been down the hardest. That's a lot of pressure on the market outside of the Magnificent Seven. Okay,
well,
everyone's aware of that phenomenon, but still, when that selling lifts and there's an absence of other quote unquote bad news, meaning we will have gotten through earnings season, even if you don't like the reactions in certain individual stocks, the overall earnings picture is just not horrendous. It's just not that bad.
It's not. And economic news is not that bad. And so if the selling is behind us, the bad breath resolves itself. This thing could change on a dime, right? Like, there's no reason why bad breath needs to persist.
We're still adding 200,000 jobs a month. Everyone that wants to work is working. Yes, there are layoffs in specific tech and media companies. Okay, we all read the newspaper. But in the end, the hiring picture right now is incredible. And if inflation is falling, but everybody is keeping their salary, guess what? That's how you thread the needle. That's the way out of this. I'm not saying you're going to get it, but there is a bull case to be made. Everyone that wants a job can have a job. Salaries are staying high. They're decelerating in terms of the rate at which they're increasing, but people are making a lot of money. And if costs start to subside, all of a sudden we're talking about back half of 24 rate hikes, and we're probably rallying into that absent some sort of a financial event. So yeah, you could have a financial event. You just haven't yet.
I just feel like what you just described is more economic news and less stock market news, right?
Well, I'm not sure that you can really disassociate the two, because remember what the driving factor was behind how the stock market did this year, XAI. These stocks were being led around like a dog on a leash by what the 10-year Treasury did. So if we are currently right now seeing the peak in inflation expectations having already been a year ago, which I think is reasonable, right? Last June, July, September. So we're a year out from those ridiculous inflation prints. And the Fed is going to say higher for longer until they cut. They're not going to be like, all right, we're not going to say higher for longer anymore. Like, we're getting into that zone where rate cuts could be in sight. And, with the stock market's going to react well in advance to when the rest of us say, oh, yeah, this is obvious. That's why the stock market is smarter than we are. So that's where I am with it.
All right, move on.
Of course, it could all go horribly wrong. Ben did a really good post last week. Everyone has more money and nobody's happy. There have been a bunch of versions of this. Noah Smith did this on his excellent Substack as well. And basically, the gist of this is that the Fed and Treasury released their 2022 data from the Survey of Consumer Finances. They do this every 3 years. And what they've come up with is that from the 2019 through 2022 period, the typical American family got about 37% richer. And it's important for me to tell you that this data actually is inflation adjusted, if you can believe that. So I don't specifically know how that's possible. We're going to roll through some of these charts from Ben, though, because I think they're important for people to just understand the big picture.
I know how it's possible, Josh.
Well, real estate and stocks, but I'm saying like
it's
still surprising. It's still surprising. Is my point. Let's do this net worth by all families. Oh, guys, this stuff is like off the charts. This is not getting back to the pre-pandemic hot. This is now eclipsing the 2007 period, which was the pre-great financial crisis high. This is what the change in net. This is going back to 1989, and so this is every 3 years. Each dot is every 3 years, and you can see that we are off the charts. The next one looks at the 3-year change in real U.S. household net worth, again inflation adjusted. This jump is off the charts, up 37%. It is by a factor of 2x the biggest 3-year jump for U.S. household net worth. And again, net worth, so incorporating the debt that people have as well. And there's no close second to this last 3-year period. One more percentage change in U.S. household real net worth by age. I mean, people under 35 are just absolutely killing it, up 143%. So it's 37% across the board. People under 35 having gotten the biggest benefit, which makes sense. They're starting from the lowest base. Fine. People 55 to 64, Michael, that's like the bulk of our clients, up 48% in the last 3 years. Would you have guessed that?
No.
I wouldn't have either, but here it is. This is the last one. I'm sorry. Net worth by age of reference person. So just think about these numbers and what. So when you ask like, how do we get out of this situation with high rates and earnings falling and et cetera, there's like a demographic backdrop to this where the people that we need to spend more money and to have that multiplier effect, those are the people that have seen the biggest increase in net worth over the last 3 years. And that might be the way that we pull through this whole thing. What are your thoughts?
Ben and I went deep on this today. I don't think there's any correlation whatsoever between net worth and happiness, especially at the lower end, because your net worth is not your income. Your net worth is, okay, what is my 401k worth? Well, I can't spend that. Your net worth is your house. Well, okay, I can't spend that either. And so even though real incomes also might be higher, people adjust. Here's where I've landed on this. People adjust very quickly to their higher wages, but they don't adjust very quickly to higher prices. You can't fucking believe that sandwiches are $17. Like you can't wrap your arms around that. We have those conversations at dinner with other couples all the time about how expensive everything is. And so it's not some giant mystery why there's a gap between soft data and hard data. Higher prices are really, really, really messing everything up.
So this is a really key point. Like when you go to buy something and it's significantly higher than you remember it having been the last time you bought it, whether that's a high frequency thing like a lunch or something that you don't buy until like a few years go by, like an appliance or whatever, you don't remember in that moment that you yourself just got a 10% raise.
Correct.
That's almost irrelevant. Yeah, of course I did. I deserve it.
Yeah.
Right. You forget that there's a reason why we're in this situation, and that is there's been a big jump in comp for a lot of people, and they're spending more, and that's why prices are able to not just go up but stay up. We're not talking about supply chain shit anymore. Now we're just talking about this is what people are willing to pay. So you really don't have a choice until that changes.
And it's notable everywhere. Coca-Cola prices are up 25% over the last 3 years. I went to the Garden, and Robin got a double Casamigos, and it was $47.
Yeah,
And
I could've told you that.
I
That's
can't.
that's the wrong place to be looking for rational
Whatever,
prices.
but I can't believe it. And it's not just the gardens, everywhere.
Yeah.
I can't believe it.
Can we back up for a second? Robin is drinking double Casamigos. She's drinking like doubles of tequila now. Is that what's going on?
I mean, it's 2 shots instead of 1.
How are things at home, Michael?
Pretty bad.
Okay. Listen, I get it. All right.
No, we're great.
You really are. That's why it's one of the things I hate about you most. All right. So you.
Oh, but look at this chart. Throw this chart on. So this is the chart. It's okay. So this is a chart of an index of consumer sentiment, and it's showing the actual. So how did people predict they were going to feel versus how they actually felt? And it tracked very well. When the economy was doing well, people felt good. And when the economy was doing shitty, people felt shitty. That is no longer the case. Objectively, the economy in aggregate is doing well and people feel shitty. Now, there's definitely people that are being left behind. Inflation is absolutely hurting people. Subprime borrowing costs are punishing people on the lower end, even if they've been a huge beneficiary of rising incomes. It doesn't matter. It's all being eaten up by the higher cost of capital. And this break happened during the pandemic, and it happened during this inflationary period. That is a gigantic spread.
So one thing, I don't think we made the chart for this, but one thing from Noah's blog, I think his big takeaway is just how widespread this improvement in net worth is. It's literally every group, but when I go through like some of the specifics,
it's erroneous.
Well, it's not erroneous. Do you not know what that word means?
It's not relevant. It's not relevant.
That's not what erroneous means. Erroneous means it's an error, like it's false information.
Oh, fuck off. It's not relevant. You know what I'm trying to say. Don't grammar check me. It's not relevant.
No, grammar is not the same as vocabulary.
I hate you.
I think that this part is relevant. I think this part is relevant.
Net worth is not relevant to people's happiness. It's just not.
Oh, I agree. I agree. But what I was going to say is, doesn't it work the other way around though? If everyone's net worth declined by 37%, don't even bother telling me how much their income is up or down, because that would be irrelevant, or in Batnick speak, erroneous. So it might be what you're saying might be true, but the reverse is not true. You agree with that?
I agree with that.
Okay. So all things being equal, people should be happier, even if they don't like the prices they have to pay.
I don't agree.
Because if this were the reverse, it would be, well, think about
it. Dude, if your 401k went from $51,000 to $65,000, should that make up for the fact that your borrowing costs for a mortgage are through the roof and you can't afford a house? Should that make up for the fact that like your groceries or whatever it is, the prices are crazy? I don't think so.
No. And it doesn't. And that's and by the way, that probably explains things like the surprise index. Like things are just not as bad as people feel like they are. And the economists are human and they live normal lives. And maybe that taints their own estimates or their own approximation of what the data is actually going to come out as. And maybe that's like part of the stew.
Now we spoke about in the stock market about the catch up or catch down. What do you think catches up or catches down here? Do you think how people feel catches up to reality? Or do you think, and when I say reality, listen, people that feel shitty, there are people that are doing shitty that feel shitty, right? Like that's normal. But do you think that in aggregate, and of course the economy is very personal, but do you think in aggregate the economy catches down to how people feel? Or do you think that things continue to get better and people catch up to how the economy is performing?
I guess I just don't remember a time where I could have said with a straight face, people seem happy. I think in hindsight, we go back and look at like 1997 and 1998, and I was an adult during that period of time. And it's obvious now that there was much more reason to be happy than not happy if you were around back then. But I just don't remember it that way, where everybody was walking around with a giant smile on their face, high-fiving each other. So I don't know what the survey data from back then was saying, but I can't think of a time where there was like this just universal, hey, things are good. I know we've had those stretches in the last 10 years, but I don't feel like 2013 might be a really great example. I did a blog post that year called Everything is Awesome. And, the song from the Lego movie that came out that summer, things like basically seemed good for the first time since the financial crisis. That was,
You know what?
5 years post-crisis, but that didn't last very long, but we do have those periods.
I think I reject the notion that people are any happier or unhappier than they were in the past. I think people are people. And I think a lot of this is our exposure to social media, unfortunately, just how frequently and how we measure these things. Yeah. I think people are people. Like, you think the average or median person is any happier or unhappier than they were in the 60s, 70s, 80s? People are people.
You know why it's also bullshit? Somebody could be happy financially, but unhappy in their marriage, or maybe they got a kid locked up in juvie, or maybe their dad got a cancer diagnosis, and it's like, hey, how do you feel about the economy? What, you're not going to get an untainted. You guys have it mostly right. The surveys are garbage, almost a complete waste of time if you're an investor. Other than, and I hear people say, oh no, at extremes they're important. Yeah, they've been pretty extreme for a pretty long time now, and I really don't know what you do with that. I'm not 100% sure what you do with it. So I like the anti-survey mentality. I think I'm getting there myself.
Credit to us. We're early to that. All right, let's talk about interest rates. So we've spent a lot of time talking about why interest rates haven't impacted the Fortune 500 companies or the S&P 500, and why the smaller stocks are getting hammered. This is such a great chart from Mayhem for Markets. It's showing the effective interest rate. So what are the borrowing costs for the top 10% of the S&P 1500? And it's very, very low, as we've spoken about ad nauseum. Then it shows you the middle 40% of the S&P 1500. And then it shows you the bottom 50%. Ooh. And the bottom 50%, these are the subprime borrowers and the subprime companies. And it's no wonder, next chart please, John, why the S&P 500 is up 10%, but the mid caps are down 1.5%, and the equal weight, same thing. And then the Russell 2000 is down 5%, and then the micro caps are down 14%. It is very much... I feel like this is very much, we're seeing this in the real economy, and you're seeing this on Wall Street too.
I just thought of the greatest idea for a chart for you and Sean, if you could do it. Take this first chart, put that back up, John. Take this, turn it upside down, overlay it with the next chart. Let me say it.
Yeah, it's the same thing.
Well, no, it's like the reverse.
Yeah.
So another word. So all right. So in the first chart, we're saying the top 10% of the S&P 1500. So these are the 150 largest companies. They're paying an effective interest rate around 2.5%, and then we're saying the bottom 50% of the S&P 1500 is 5.5% to 6%. That's a huge disparity in interest rates. Yeah. But then when you look at stock market performance this year, it reflects exactly that. The worst stocks are the ones that are being hit with these higher effective borrowing rates, and with good reason.
Dude,
and,
this is
one of those years that's but it's it shouldn't be this symmetrical. It's too perfect.
This is another reason why there's a disparity in different cohorts feeling the impacts of interest rates differently. So prime borrowers for car loans, I can't say that word, borrowers. Prime borrowers are paying 5% for a new car and 7% for a used car. Subprime borrowers are paying 21%.
Yeah.
Massive gap.
And they got that cohort just got themselves a huge raise. We know that people at the bottom of the income distribution had the biggest increase.
Yes, but it's all being eaten up. It's all being taken away.
By the way, the bottom 20%. This is from Noah. People in the bottom 25% of the wealth distribution saw the increase in their net worth up 900%. 900% in 3 years. But those are the people now paying the 20% borrowing rates. So of course they're not thrilled.
And so their net worth went from $7,000 to $26,000 for money that they can't spend.
Yeah.
So that's it. All right, let's move on.
Okay. Where are we going next?
Who are you telling to stop crying? The people in your LinkedIn mentions?
No, this is this is Barron. This is not even me.
That was the title of their cover story?
I didn't say this. I think.
Oh shit! Wow.
It's time to stop crying. It's time. I don't tell people not to cry. I think people should cry more. It's time to stop crying about bonds and buy them instead. Is literally the Barron's cover story. Now, a lot of people would look at that and say, go the other way because it's Barron's and blah, blah, blah. Yeah. No, I don't think so.
I don't think so either.
I don't think so. So in the third paragraph, they get to Bill Ackman, who very notably tweeted out shorting the long bond and then covered 6 weeks later and nailed the trade and said the world is something like paraphrasing, the world is too fucked up to be short Treasury bonds. I agree with him. But let's get to some of the points here that I thought were interesting. Dan Iverson, who took over at PIMCO as a portfolio manager, chief investment officer from Bill Gross. It's about $1.74 trillion in assets, a lot of it in fixed income. I think he summed it up very nicely with his quote. It's been a rough journey to a much better environment. We're much more optimistic at this point going forward. Yeah, no shit. You've had a pretty big de-risking in terms of rate hikes this year. So the long bond, I thought this was interesting as well, is a case for significant gains with far less downside risk based on bond math. Bond math is like how much you could lose versus how much you could make given a move in interest rates. So on the 30-year, would gain 13% over a 12-month period if yields just dropped a half a point. And that's based on current levels right now. They would lose less than 3%, however, including interest, if rates rose by a half a point. So there is an asymmetric. It's not to say that there won't be volatility in the TLT, for example, but there is an asymmetric situation now in longer dated bonds, precisely for the reason that people already got killed, and we've already seen a lot of the damage of higher rates. So look, you've seen money piling into the TLT, which is the 20-year Treasury bond ETF for iShares, $12 billion of net inflows in the last 6 months. And that's as it's literally dropping like a falling knife. So I think that's the smart money that's like able to fade that sell-off, understanding how bond math works. What do you think?
I do think that we did a whole segment on this last week on this very show where we spoke about the asymmetric math in terms of the path of interest rates. And there's been a lot of people saying, well, that chart is bullshit because a lot of it is a short trade. And that's not true. If you look at the TLT, I think 10 or 12% of it is held by shorts. So it's not nothing, but a lot of that money that you just mentioned flowing in are real buyers, real actual buyers.
One more thing on this. I should make a list of these things where nobody pays attention to them ever, and then all of a sudden they become the single most important thing that everybody watches, like the Super Bowl.
What's on that list?
So I think in like in 2015, 2016, it was rig count, because oil prices had just got cut in half and literally were like wrecking economies around the world.
Remember the Baltic Dry? The Baltic Dry Index?
Let's do that one day. But for now, let me add another thing to this list, which is the quarterly refunding report from the Treasury. So this comes out.
Never heard of it.
We're recording this on Tuesday. I know. And you never will again in 6 months. This comes out tomorrow morning. We're recording this Tuesday night, so it'll come out at 8:30 in the morning. Treasury gave a little bit of a glimpse into what to expect. They said, "Hey, we'll probably be selling less bonds than what we had been expecting to sell," and that obviously led to a rally in bond prices and a cooling off in bond rates as a result of that. Tomorrow, when they put out this quarterly refunding thing, they're going to announce the composition, which means how much of each maturity of Treasury bond are they selling? Like, can you imagine, like, even a year ago, anybody giving a shit about this ever? Nobody.
Who was I listening to?
This has been coming out. Wait. This survey has been coming out for 1,000 years, and not one equity guy has ever paid 1 second of attention to this. For some reason today, it's all I'm hearing about. Well, wait till we see the composition. Well, what the fuck are you going to do with that? Absolutely nothing productive. What is that going to tell you? Is that the Rosetta Stone now for why you're underperforming FANG stocks? The composition, moron? Anyway, this is like the new thing. So you're going to see people lose their minds over this thing that they never even heard of until a week ago.
This is not the new thing, but to the point of this being the new thing,
the new thing I'm saying for right now.
To the extent that this is the new thing, don't fuck with my erroneous. I will continue to use it as I've been using it. Demotoring was on O'Shaughnessy's podcast. He's like, there's too many people combing through economic data. Like this was not.
Yeah.
It's all nonsense.
Wasting their time.
It's all nonsense. Speaking of nonsense,
this is hold on, more? But just one more remark on this, okay? Tom Lee had been talking about. He wrote about this. He said our macro clients note that the Treasury quarterly refunding is arguably more important than the FOMC meeting, and how the Treasury announces its coming mix of bonds. This will be market moving. So far be it from me to argue with Tom Lee. And he's probably put a lot more thought and research into this topic. I don't think anybody really cares.
Well, let's just stipulate that it is super important. Fine, good. I don't need to like outperform based on what my, whatever. All right. Let's talk about I mean, what I just saw. I have no bandwidth for that. Let's talk about dumb money. All right. This is from the Wall Street Journal, Vanda track via the Wall Street Journal, Vanda Research. The average individual investor stock portfolio has risen about 150% since the beginning of 2014. That beats the S&P 500, which did 140% during the same period. So Vanda calculates the average portfolio by analyzing individual investors' brokerage accounts in U.S. listed single stocks. So we exclude mutual funds. You exclude ETFs, which kind of makes sense for this analysis because if you're holding the S&P 500, you're not trying to beat the S&P 500. This is interesting. The typical small investor, next chart, please. The typical small investor holds an outsized position in mega cap tech companies. Apple, Tesla, and NVIDIA alone make up about 40% of the average individual's stock portfolio performance. So I heard a joke from somebody about a husband and a wife who went to Vegas. And in this case, the husband is the professional stock selector and the wife is the retail investor, where the wife made $500. She says to her husband, I won $500. How'd you do? And he said, like, I lost $2,000. And she got mad at him. He's like, yeah, but I know how to gamble.
Yeah, exactly.
Right?
Right. So, he has a system and he's a pro, and she just put it on black, and the results are the results.
Yeah. So I think the entirety of the last decade, with all the frustration, which I am very sympathetic to, all the frustration on stock pickers who cannot perform these, I'm using air quotes, dumb money, because the dumb money bought the most popular stocks for the last decade, the Apples, the Teslas, the NVIDIAs, and that's all you had to do. And in the eyes of the underperformers, it shouldn't be that easy.
Yeah, that's exactly right. It's such a great point, Michael. Like it's one of the first things that you're taught is not to buy glamour stocks and not to buy things just because they're popular. And, just because something is a great product, that doesn't mean it's a great investment. Throw all that shit out the window and you actually win big over the last 10 years. And it's not supposed to be that way.
Because I'm using air quotes because I was so smart. My brain got polluted with that shit. Like, oh, yeah, Apple's such a great company. That's why it's
everyone
the biggest stock in the world.
Already in the stock.
Yeah. Guess what? It wasn't.
It wasn't in the stock.
Second order thinking,
far from it.
Second order thinking failed spectacularly over the last decade.
Second order thinking is like, you know what? I'm going to build a portfolio of all these MLPs trading at 3 times cash flow. Right. All right, good luck with that. How'd you do?
Yeah.
You're so look how sophisticated you are, asshole. So, where all your clients go. So yeah, that's very frustrating, and I think that lends itself to a lot of the nastiness online amongst professional investors.
Oh, you think? No, yeah.
No, all right. I think,
and I get it. I
know for sure. Yeah,
I get it. I really do. So again, Demoterin had this great comment that I wanted to share with the audience from Patrick O'Shaughnessy's podcast. He says, when you say that private equity and venture capital benefit from low interest rates, they did. But collectively, it wasn't a good decade for either. The average VC investor, the average PE investor made about as much money as the average S&P 500 investor. Of course, there were winners. There's a selection bias with PE and VC when you look at the winners. One of the talks I gave is, who put the quote smart in smart money? Because I looked for 40 years for the smart money that presumably gets in before everybody else and gets out before everybody else. There is no group of investors that I can point to and say that money is smart money. It's just greedy money that ultimately runs into a wall sooner or later. So I think there's going to be more accountability. Okay. He said collectively as a group, I don't see groups benefiting or paying a price because the average is still the average. I thought that was really, really well said.
It is. I have so many caveats to this, though. There is smart money. It's just that you don't get to stay the smart money forever. You have a market environment where winners keep winning because they are the smart money, and they have their era. But their era doesn't last 40 years. You're not the smart money for 40 years. You could have 5 years. Like I know you love the Andreessen and Horowitz guys, and I have a ton of respect for them. So no disrespect intended. And Tiger and all these dudes, they were the smart money of the 0% interest rate era. And I'm sure if they were in a room and there were no media and no press, they would look at each other and say, yeah, we really did benefit in large part because money was free and people were willing to go out on a limb for, and take equity for companies that were not earning anything. There were no cash flows. People were willing to dream big, and we were in the right place and we had the right connections. And we deserve to have won, and that's a big part of why we won. I think intellectually they understand that. They were the smart money. Are they the smart money where rates are at 5%? And you don't automatically get an exit whenever you feel like it, and there aren't bidding wars for Series Bs, and are they still the smart money? Remains to be seen. I don't know. I don't think so.
Just for the record, I don't know why you're saying that I love the Andreessen guys. I have respect for what they've built.
Everyone does, but I'm making the point. You could look at them. They've been spectacularly successful, and they know technology, and they're experts, and they have great networks. Can't take any of that away, but they also happen to have been in this era where their type of investing made them look like the smart money, given what the environment was handing out. It's undeniable. Nobody would say, I don't think anybody would be like, nope, I would have done this anyway. You would have? You think every company that you invested in that 20x'd would have been able to if there were a, positive sloping yield curve? I'm not 100% sure that anybody from that world would say that. I think most of them would say, we're good, but also the getting was good.
Well, guess what? Here's a guy that I do have a ton of,
They were the smart money.
I have a ton of respect for Brad Gerstner. I remember the first time I heard him was on Patrick O'Shaughnessy's podcast, again, in 18. And this was one of the few guys that does what he does that was very aware of the tailwinds of zero interest rates. I was like, you know what? I have a ton of respect. Nobody's saying that. Nobody who's winning big is saying that. And guess what? He's still got his chopped off. Yeah. And you would say, if he's not the smart money, who is? Yeah. And he still got annihilated, overstayed his welcome.
So my caveat to Demoterin is there is a such thing as smart money. It's just not permanently the smart money. The cohorts, the cohorts change. You look at the icon generation in the 80s, the corporate raiders, they were the smart money. Now, a lot of being the smart money involves making your own alpha. And I think this is an important point too. We don't have time for it right now. But when you look at the investors who dominate these particular eras, one of the things that you find is that they are so powerful in those moments that just by virtue of them getting involved with a stock, they can make the stock become a winner. They can convert enough other buyers to pay up, and that applies in VC, in private equity, in a lot of areas where just by virtue of me saying I'm involved in this thing, that creates a sort of alpha. It's almost like a celebrity alpha, and Buffett has benefited from that at times. So there is always a smart money group. They just don't typically pole vault themselves out of one boom into the next one. They usually have to go away for a little while and not be considered smart as a new group takes over. I think it's a fair statement, right?
Yes.
Okay, let's do this Apple thing quickly. Did you watch any of what they released last night? Did you have a chance to see it?
No, but okay. I did laugh at what you said on Slack.
Yeah. Well, they're coming for that GPU money, my friend. So
Josh said that Apple just unveiled the NVIDIA killer.
I think
The stock is up 1% today. Yeah. I know it's down 1%. I'm sorry. You're right.
Well, actually, NVIDIA is down because of China, whatever the fuck.
All right. What did Apple unveil?
I thought this was important. Apple's MacBook Pro laptops are going to be supercharged, and they will not include Intel chips going forward. Apple launched the M1 line of chips, and people said, "Oh, that's cute." Apple's doing its own silicon. Who cares? It's a side project, whatever. They are now launching 3 nanometer chips. They are on the very cutting edge of silicon, and they launched 3 versions of the M3 chip last night: M3, M3 Pro, and M3 Max. And when you watch this presentation, you recognize the similarities between when NVIDIA put out its H100 or puts out some of its GPU stuff. They're using the same terminology, and they're showing the same type of video to demonstrate the capability. But when you look at, these are video games that look like movies, basically. And you look at like the ray tracing.
Oh, that was a video game?
Yeah, dude.
Wow.
That's animated. So this looks a lot like when NVIDIA is showing off their chips, and Apple is rapidly catching up. Look, it's the combination of CPU and GPU in a MacBook Pro, and what you're really going to be able to do with machines that powerful, I think is catching some people by surprise. And all of the large Apple has become one of the most sophisticated chip designers in the world in a fairly short period of time. All of the large cap technology companies that we talk about are making their own chips. All of them. Google, Microsoft, Meta. And I think that there's like some big ramifications for the semi space.
Intel's up 2% today.
Yeah. Qualcomm has had disputes with his customers very publicly. Intel has blown it. They've had a few customers that they've let down in the fabrication process. Now they have their former customers out here running circles around them. This is a different world now, and I think it begs our attention. Do you ever think you would see Apple releasing chips of this capability this quickly?
No, but I will say, famous last words. I'm going to say that I like the Apple setup going to court. I feel like expectations are fairly low. I think it's kind of weird that they did this thing before earnings. I don't know if they normally do that, this presentation that they gave. But Apple is in, I don't know. What sort of drawdown is Apple going into earnings on Thursday?
It's enough. I think it's maybe 9%. They want to make sure that these MacBooks are selling during Christmas, and they've got the iPhone 15 at the same time.
All right, so Apple is down. Apple is in a 13% drawdown.
13
heading into earnings.
Yeah. So, but they've got I think they have the right mix going on sale this holiday season to pull out the fourth quarter. I mean, of course, we'll find out. I want to do my make the case, and then
hang on. Last thing. We had spoken last time Apple reported. It was, I think, the 3rd consecutive quarter of year-over-year revenue declines. Yeah. Of course, there hadn't been a new iPhone. We did get the new iPhone this quarter, so this is an important earnings call.
Yeah, I think there was like 10 days worth of iPhone sales bleeding into the prior quarter, but this is the full quarter effectively.
It's important
of the 15, and I think I agree with you. I think it's important.
All right, what are you making the case for?
So this is a stock I sold, and that's how you know it's going to keep working. Remember, I did Arista Networks here as my mystery chart.
Yeah, not long ago.
Yeah, and it wasn't a fair mystery chart because it's like an off the beaten path name, but I was pointing out it was the best performing stock of the year, or one of the 10 best performing stocks of the year. This thing continues. So they put out earnings last night, and I would tell people to get on the Quarter app and go listen to that earnings call and learn the story. I'm not telling people to go buy the stock right now. I will not buy it back because I just sold it in the 180s, and I'm very stubborn. And so I'm absolutely convinced that so long as I stay out of it, this stock will continue to levitate right in my face. But I would just make the point here. NVIDIA is not going to have AI to itself. It is really hard to build GPU accelerated data centers without the correct communications equipment. And that's Ethernet, and that's Arista Networks. They are the pure play. They're not the only, Cisco is in this game as well, but Arista is being bundled with NVIDIA in design wins. So like at the enterprise level, if you're going to do data centers and cloud computing with the express purpose of AI workflows, you need a communications network built in. Otherwise, I don't care if you have 10,000 GPUs. If they're not talking to each other and connected to the network, you have nothing. So that's the backdrop behind which this stock continues to crush. They beat on the top line. They beat on the bottom line. Earnings were $1.83 versus $1.58. Revenue was $1.51 billion. That was up almost 30% year over year. Operating margin 63 versus 62 expected. So this is just, for me, this is like the one that got away. I was in it. I got spooked out of it by the overall market. Look at this gap higher. John, throw this up. This makes me want to kill myself, honestly. But you've got let's do the analyst real quick. So there's a lot of coverage here, and most of it is obviously bullish. The high target on the street is 232. The low target is 180. So even the neutral people, like, they're not significantly lower than where, or the sell rating, not significantly lower than where the stock is now. And I don't know. She's knocking on 200. Want to throw this chart up? Last one. She's knocking on 200. This reminds me of Nvidia, honestly, where like people were like, all right, I'll buy it when it goes down. And then like it triples and then it goes down. So I don't really know what's going to happen here. I'm not in the stock and I'm not telling people to buy it, but I really feel emasculated by this whole situation. Anyway, I made the case for Arista. Where's my mystery chart?
Wait, before we get there, I just have one data point that I want to share that Barry actually just sent to me. So Jonathan Harrier tweeted this. This is really interesting. We spoke about the washout. All right, so he tweeted yesterday, these two criteria happened. The percentage of S&P 500 stocks above their 200-day moving average crossed above 25%. So low, but rising. And fewer than 20% of S&P 500 stocks were above their 50-day moving average. So pretty much a washout.
Yeah.
This has happened.
He had a huge update yesterday.
This has happened.
Dow up 500.
14 times since 1985. So pretty rare.
Okay. Yeah.
And it happened in July 2008 2 times. And you know what the forward returns were for that, right? It was really not good, obviously. But if you take those out, so of the 15 times, if you take away 2008, it was positive every time a year later. And what you're just basically saying is we just had a washout. That's what it was. Like I said, it's weird that the washout only resulted in a 10% drawdown in the S&P or 13%. But interesting data point nonetheless. That's from @Jonathan Harrier. If you want to get more information on that. All right,
I'm in the washout camp. So
my mystery chart is it's funny. I almost brought this up last week that like if this chart breaks, it looks like it's going down a lot. And this is sometimes why technical analysis works. You look at the, I don't know, what is that, like $11? Just how much support there was.
The buyers came in every time for over a year. And then one day they didn't.
Yeah, like in a big way. And then one day they didn't, and it broke spectacularly. I mean, that's a big break from $12 down to under 10.
This is an individual stock?
It's an individual stock. So I'll give you
Give me one other clue.
One more chart. So this is a long-term view of the market cap. And this company has traded in a long, sloppy, disgusting mess for the better part of the last 25 years. It had a market cap as high as $60 billion in 98, 99. Market cap of, I don't know where that peaked, around $100 billion in 2021. And now it's down to 40. Just a real awful piece of shit mess.
$40 billion market cap and it's trading at $9 ish.
Yeah. And it's probably one of the most heavily traded stocks on Robinhood just because of its share price and it's a brand name.
Is it Ford?
It is Ford. Wow.
Yeah. I'm pretty good.
Good for you.
This has always been a piece of shit my whole career. So the start of this long-term chart that John has up, that's when I got my Series 7.
It's unbelievable.
So
really,
and we used to pitch Ford because it was like out of favor. Like we used to pitch this to prospective clients. Like, here's like 5 reasons why you should probably buy some Ford right now. And if they had a Ford in their driveway, they were like, yeah, all right, $8, I'm in. And you could have held it for 25 years. It's back at 8.
I want to make one more point.
That ramp though in 21. Do you?
No, I don't. But I guess it was following Tesla. I don't even know. But I want to make one more point. I want to make one more point about that chart. Chart back on, please, John, the long one. So this type of stock, the Bessemer study that shows that 2% of all gains come. 98% of all gains come from 2% of the of the listed companies, whatever that chart is.
Yeah.
But that also misses the point that and I'm not saying that it's easy. There was plenty of opportunities to get long Ford, right? Like within this 25-year period
and make tons of money
of nothingness, there were several really huge, spectacular runs. Just wasn't a stock to buy and own.
Look at this rally off the great financial crisis low. GM actually went bankrupt and Ford didn't. But Ford's equity price was probably like $4.
That's like a 15x.
Again, General Motors filed for bankruptcy in 2009, and Ford didn't. And then when things bounced, Ford went crazy to the upside. So there were plenty of trading opportunities along. But just because you have diamond hands doesn't guarantee you a long-term reward in any stock. I don't care how much you love the product or the brand.
Like most, and when I say most, like almost all, most stocks are not worth buying and holding forever. Yeah, the Apples of the world.
Right. So that's so controversial to people because of Warren Buffett. He happened to have picked 5 or 6 of the best long-term stocks of all. He picked American Express in the 1960s. Is that really what you think you're going to do?
Right.
You think you're going to buy a stock that 60 years from now is still in business, let alone successfully in business? Like, it's really, really hard. Actually makes what Buffett did so incredible. And he's had losers along the way too. But like him picking Amex, Coke, and a handful of other names that happen to have turned out to have been some of the greatest companies of all time, that's not the example that we should be trying to follow because it almost can't be done.
Here's the data point. The data point is from a report by JP Morgan called The Agony and the Ecstasy of Stock Picking. 70%, 7 out of 10 companies in the Russell 3000 have had a 40% decline from which they never recovered. 70%.
So they fall and then they never come back to where they were.
40%. Yeah, no, that's the number.
You said 70% of the companies?
70% of the companies have at least a 40% decline from which they never recover.
More than 2/3 of companies never get back to an old high after a decline like that. That's incredible.
Incredible.
I mean, it's intuitive also. We should understand that because businesses are perpetually competing each other out of business. But still, just hearing it that way, that's pretty amazing. And on that up note, we're going to remind everybody that tomorrow is Wednesday.
Stocks are spooky.
Stocks are spooky. Tomorrow is Wednesday, which means when you wake up, another all-new edition of Animal Spirits, starring Michael and Ben, my favorite podcast. Get it wherever fine podcasts are played. Later this week, we'll have an all-new Ask the Compound with Ben and Duncan on Thursday afternoon. And then we'll finish the week with an all-new edition of The Compound and Friends on Friday. We're going to have special guests and a lot of fun. So stick around. Stay tuned for those shows. You got anything else for us, Michael Myers?
Nope.
All
Happy
good?
Halloween.
All right. Happy Halloween, everyone. Have a good night.